In today's video, I am going to be breaking down my top best favorite ETFs that pay dividends for the month of July. Let's get down and let's check these out. So the first one I'm going to talk about is ZWA, the BMO covered call Dow Jones Industrial Average hedged to the Canadian dollar. Now, why is this one so important? Well, of course, we do see a strong history, but I think that there could be a big push to the Dow this month, mainly because of a lot of the tech stocks, and I also think that there could be a little bit of a push when it comes to retail as well. Now, this one doesn't have a huge volume, but it does have a pretty strong dividend of 4.5%, mainly because of the covered call strategy. What is a covered call? Basically, you own stock and then you sell calls against those stocks, which then you get a higher dividend because of the premiums from the call option. The MER on this one is 0.72%, which is a bit higher than most ETFs. However, it is on point and on average when it comes to covered call because they're more of an actively traded ETF. Now, if we look at the 5-year average, or at least the 5-year, I should say, charts, we see that there was a nice run-up through 2017. From 2018 to 2020, I'm going to say that there was a slight increase, but at the same time, it pretty well traded sideways. Obviously, coronavirus just destroyed the market, and then it has grown since, and it has gotten past that fake level of resistance, I'm going to call it, recently, and it started to level out and, of course, consolidate, which is sometimes good after a big push, a big run. So I think that there could be a little bit more of a run coming very soon. Now, it does pay a 10-cent dividend every single month, so at least you see that there is a strong case for a dividend that is pretty well standard across every single month. Now, something that I do want to pay attention to is that 12 cents. The reason for that, in my opinion, is because that was back in December, and sometimes what we will see with the BMO ETFs is they'll do a special dividend, and that could be a special dividend, or it could have been just the fact that in these months here, there was a lot higher call options being purchased, more options being sold, so that could be why. Now, the stocks on ZWA are really interesting. So, of course, we see the banks, and I think the American banks could have a little bit of a run because they are all raising, or at least most of them are raising their dividends substantially. I think retail is going to be pretty strong. Tech is going to have a strong push as well. And, of course, with all of the stimulus that's happening when it comes to the infrastructure bill, Caterpillar is going to be really succeeding. Every company is going onto the internet. Salesforce helps with things like that, as well as being able to run your business in general. McDonald's is McDonald's. I'm not a huge fan of it, but there it is. And of course, Honeywell, I think, may have another push. Now, with CI tech giants, what I really like to see right now is all of the tech stocks. I think that tech could have a big push over the next couple of months, which would then see this stock price rise. Maybe not as high as a non-covered call, but at the same time, with a covered call, you're also getting an 11% dividend, which is massive. You're getting 44,000 average shares traded per day, 0.71, which is again high for ETFs, but about average for covered calls. We can see that it's had a nice history. We keep on seeing double bottoms, which is nice to see. It's recently broken past its level of resistance. It's up around that 2163 range, and I think that that could continue to go. It's had a nice consolidation and it's broken through. We can see it's got a nice, long, big history of massive dividends, and we see that they keep on rising as well, which is really nice to see. Their top holdings are some of my favorite companies: Nvidia, Applied Materials, Google, Oracle, Intuit, Adobe, Facebook, not really my favorite company, but they are there anyways. Salesforce, another big, massive Salesforce holding in this one. And then we're seeing also IBM, which I think, even though I'm not a fan of them when it comes to their stock price because it's been dropping for a while. I think they're really setting themselves up into the future with AI and different things like that. And of course, Microsoft. The third ETF is the BMO US High Dividend Covered Call, ZWH. And now with this one, again, 37,000 shares traded on average every single day. And what we're seeing here also is that 0.71% expense ratio. But this one has a much higher dividend of 6.28%. Now, the nice thing with this one, again, it's another covered call strategy. However, unlike some covered call strategies that drop, we actually see with BMO that it trades within a range and it slightly increases. It's back near its all-time top high, and I think I see it continuing to go higher. There is a slight W that did form, and anytime that there's a W that forms, it's usually a nice increase. We can sort of see it on this 5-year chart, but when you do go down into the 1 to 2 year charts, you can really start seeing that W forming. I've also noticed that when it comes to the 3-month chart, you can actually see an upside down head and shoulders, which again shows a rise in the stock in the future. This one is pretty well set, 11 cents per month, which is really nice. That's what's going to give you a nice standard income, especially if you're retiring. This might be a good option. And of course, the holdings, JP Morgan Chase, some of these are going to be banks in their top 20. However, in their top 10, we see JP Morgan, Coca-Cola, which is set up pretty good for the future. Microsoft is a tech company, and I think there's going to be a big tech push. I think there's going to be some really big pushes into Home Depot, mainly from the stimulus that we're seeing. Of course, they may be providing some of the tools and resources for these companies to start creating this infrastructure that the US is paying for. Chevron is, of course, oil. Their oil's going up. Verizon is tech. Apple, Pfizer, really solid companies altogether. The next one is the Vanguard Canadian capped REIT VRE. Now, I've never really talked about REITs on this channel. I'm actually not a huge fan of REITs. However, this ETF has sort of slightly changed my mind. And I think with how the Canadian market right now is setting up with houses, they're really expensive to get into, and there's going to be more and more people renting houses. I think that this could really give us some nice income. There's a lot of people who are trying to save up for a house, and the houses just keep on going up 10, 20, 30, 50, 80% every single year, depending on where you live. And renting is becoming a more and more viable option for most people, and because of that, I think VRE is going to be really set up well with a 3% dividend, not as high as all of the others. Average volume of over only 13,000 shares traded every single day, but we can even see from the 5-year chart, it goes up, it really trends upwards, which is something that I've noticed with REITs for the longest time, they don't usually trend upwards. Usually they basically stay stagnant and pay the same dividend. That's why I've never really been a huge fan of REITs. However, if you can get an ETF that holds a few of these different REIT companies like this one, and it trends upwards, that really does show to me that it's actually a pretty good investment. It's not back to its all-time high. Once, of course, Canada and the world starts reopening, I think that this could really push higher. And they do pay a pretty well standardized dividend every single month. Now, the only thing that does really make me curious is the fact that it's gone from 9.1 cents down to 8.8 cents. It's not a huge difference, but it is substantial when you start really looking at their history. But again, when you go back to 2019, they were paying also a 9.5 cent dividend, so it continues to go or trend downwards when it comes to the dividend. I'm not too sure. I would have to dig deeper into that, so this is a bit concerning to me. However, at the same time, with the trend of more and more people renting because houses are just too darn expensive, then this seems like a pretty good viable option. And like, take my story for example. The type of property that I'm looking for merely 5 years ago here in Ontario, where I'm looking 5 years ago, was around $400,000 to $500,000. It's about 2 acres of land. And now at places or properties like that with the same type of house, same size of house and everything, is now going for well over $1.5 million. It seems like there has to be a crash coming sometime. Of course, that would hit the REIT stocks. However, if we can play it until that crash happens, if you're lucky enough to get out at the right time, then you will be come very successful with that ETF, but that is something to really consider, is the possible housing crash. And that is something that I am looking forward to because I would like to get into it. My parents own their house, so we don't have to worry about them and their mortgage or anything because they don't have one. However, for myself, I would really like to get into a place that has like just not stupid pricing. That's just ridiculous. For a house to go like 3x in like 5 years, that's ridiculous. Next is going to be the BMO Covered Call Technology ETF, ZWT. This is actually very similar to the other covered call that I was talking about, the CI Tech Giants TXF. Very similar here, but I really wanted to mention it mainly because it is in that tech sector. Now this one, even though Yahoo messed up, and I didn't notice that when I was recording my screen, they pay around a 5-ish% dividend, and the volume isn't as high as that CI covered call. However, you are getting very similar stocks, and some people may prefer the BMO option over this CI covered call. This one hasn't been around for as long, so we're going to see not a great chart. We can see that it has hit essentially a double bottom twice, even though this one was a dragged out consolidation of a bottom. However, this one did have a double bottom that we can see there. This one had a single bottom with pretty high volume, so that is something that I do personally look at. It's also gotten and broke through its high twice, so of course, will it pull back? It's hard to say, but at the same time, I think again tech stocks are going to make a big push this month and maybe even next month. Again, not been around for very long, but it does pay 13 cents every single month. And its holdings is Facebook, Alphabet, which is Google, Microsoft, Amazon, Apple, Visa, MasterCard, Nvidia. Now, the difference here is Nvidia is lower on the chart versus the CI. Nvidia is higher. Nvidia, I think, has the greatest growth potential out of all of these. However, PayPal may show to be maybe a strong number 2, or even Alphabet, which is Google, which is YouTube, may be a strong number 2 as well. So I am sad that Nvidia is not higher on this list. I would personally like to see it number 1 because I think that it will have that massive growth potential. I hope that this video helps you kind of choose and pick and see what different options are out there for you. Remember, don't trust a random person on the internet. Always do your own research. I hope that you've enjoyed today's video. If you have, hit that like button, subscribe. I'll see you guys again next time.